Good morning, Doug.
Hi.
You are
How
going
are
to
you?
town, writing notes down there. So it is a beautiful day in central Indiana.
I'm looking at your disclaimer. Stay behind the fence. Have you ever built a fence?
Probably. I don't remember doing such.
We had an awesome fence in one of our first homes, and that protected our garden from the rabbits and the critters that would come. And it is about to be garden growing season. I think Jeff Cash is going to deliver a couple tomatoes tomato plants to us this weekend. So I'm pretty excited about that.
Cheers, Jeff. I got to see him this week. That was fun.
Yeah, we got to honor Debbie and through Debbie a retirement party. And it's great to see her.
Oh,
Man, I can't believe it's been what, 5 months? And yeah, it was wonderful to celebrate her and be with her. We had a great turnout, and thank you all for coming to that. That was super special for her, I know, and for me too.
I discovered that people don't do retirement parties anymore in general at big corporations, and just thought that was cool that we were able to honor her in that way.
It was super cool. Speaking of retirement parties, I was reading a retirement vision from one of our clients the other day. He retired in, I believe, it's 2014, and he set out a mission statement to what he was going to be about during his retirement. And it was so cool to read it because it included lessons learned from his profession and what he wanted to say yes to and no to. But the big events were family time and friends, being available for family and friends. And so if you're watching this and you're retired or not retired, some type of vision statement is healthy. And what's the saying? If you can't write it down, or then you can't communicate it, something like that. But anyway,
I generally have a weekly vision statement.
Yeah.
I know I'm not a big goal guy, but I just try to every Saturday, Sunday, Monday look at my week and say, what do I really like? What's really important to keep?
is this your big rocks?
Yeah. I just write down what I think ought to get done this week. And this week, it was a little freer than last week. Last week went off the rails with things not in my control, but this week I got to do some of those things. So it's fun.
That's cool.
Yeah. Let's look at
Speaking
the
of
market,
vision.
shall we?
Yeah.
Last week, before we kind of jumped off the rails, not talking about the economics things, I was pointing out to you, and I know sometimes on this I seem maybe a little more pessimistic than Doug, and that's what's beautiful about Gimbal. We can all have our unique personalities and opinions. And last week when we were talking, I was just pointing out one of the risks that I saw in the market that was still out there that nobody was talking about was the banking industry. And when I showed this to you last week, this stock, First Republic, was trading at $6.60 a share. I think if you go back and watch it, I said you could buy all you want at $6.60, which I would not recommend doing. By the end of the day, you could have bought all you wanted for $3.50 a share. And last I checked, let me look here.
Yeah, I saw this earlier.
I think last I saw it was like 26 cents a share.
Mhm.
And
Yeah.
and so we've told you multiple times over the years that all stocks are speculative. I showed you how this one hit over $200 a share prior in the same year or so. And consequently, there is still a banking crisis going on. And I thought we might address that before we even jump into the market. I didn't see the news close enough to be able to tell you. I know that I saw one or two others besides First Republic. Did you see other
I
bank
did,
stocks?
but I can't recall names.
Okay.
Yeah.
And so the stock market is just supply and demand, and a lot of that is driven by human emotions. And I've found that when people are asking me whether they should move money from bank to bank, that they're not oftentimes thinking, boy, should I jump into the stock market? And so there's not that rush of money coming into the markets with that situation. I don't know if you've had people ask you, Doug, about the FDIC coverage, but a financial plan is really not something you cast once a year and do. It's an ongoing, evolving phenomenon. And so the FDIC is probably part of your financial plan. It's called risk management. And to the best we know, it's $250,000 per account, right?
Yeah, that's what they tell us.
And so if you have more than $250,000 in a account in one bank and you're not sure what to do, let us know. We can give you their website to check that. We're happy to talk to you about different registrations, what that might mean. But there is risk in all sorts of things.
Yeah, and most of the time, there's kind of blindside risk, the risk that you don't see out there. And normally the risk that you don't see is in the investment or in the thing that you have just maybe you've been good at, or maybe you've trusted it, or you've had some success with it. And we're blind to the risk associated with that. And we see that sometimes in real estate. I see that in my own trading at times, that it's good to have rules. It's good to have guidelines. And that's something that I'm really proud of here. We've been very clinical about how we do our investments, and clinical means we're always testing it. We're always open to improvement, and we're open to feedback when it doesn't go the way we want it to.
I've mentioned the option traders on this show from time to time that kind of helped train me back in the 1980s. They said that we're often wrong, we're often right, but we always have an opinion. And so
Never indecisive.
yeah, I think everybody always has an opinion or is not indecisive, but we're willing to admit when we make a mistake as well. And I think that helps you be more objective and honest as you're helping people.
Yeah.
That's probably one of the hardest things for anybody doing any aspect of life, is to be honest and objective, because this little pooch I have above my belt line, I didn't do that, right? Like, that just showed up. Who did that? Yeah. And so I can't really blame somebody else for what's going on there. And so that honesty and integrity with myself really helps me be more so with you guys as well. Here's the S&P 500, Doug. What would you say about this guy?
Well, okay, so the S&P 500, it's just okay. You know, I do love that we're above the 200. We spent so much time underneath the 200-day moving average last year. Did we spend all of 2022 almost?
Let's look here. I'll give you the update.
I think it was pretty much like February or March to the end of the year. But yeah, what's it say there?
April. Well, we violated it right here. We got above it.
Yeah, we had
We got above it there. We didn't get above it there. We had these days above it.
When did it violate? That was back in pretty much
In middle of January.
So here's what I like. I like that we're above the 200-day. Can you switch back to real time things? I like that we're above the 200-day. I like that we're above the 50. It's fighting for it. But if I had a concern on the S&P 500, it's this. Just look all the way to the right of this chart and to the bottom. You'll see some sellers coming in. And we're in the middle of earnings season. Several companies have reported. I was looking at a Bespoke report. Bespoke is a publication that just crunches analytical data. And this is as of last week. So far this season, 75% of the companies reported have beaten earnings estimates. Okay, while sales have been at 68%. And so that's a pretty good beat rate. However, you can see the selling that Keith just highlighted with the red lines. The sellers have come out the last couple of days. And so this is interesting, but I'd love to talk about, unless you want to talk about this more, I'd love to talk about the weekly NASDAQ.
Well, before we get that, our friend Patrick says it's not really the news. Like, even though 75% have beat, it's the response to it. And so the response isn't just because you announce really good earnings doesn't mean that the stock goes up. It could get smacked in the face. And that's one of the things I've been watching this last week is the top leaders in the market that are going up and the top losers. And mostly this week, if you were one of the top stocks, going up this week, you might have gone up 3 to 5%,
Mhm.
and the losers were going down 10 to 25% on average. And that's not a market that people are rushing to jump in and buy more stock. So if I can go over to the NASDAQ weekly,
Yeah.
you said?
Yeah, this is something that I like the look of this. I really like it. You can see the way I would summarize these last few weeks. So each vertical line there in between Keith's two horizontal lines, that represents 1 week's time. And what we're seeing is a real fight to steal a title of a book, a fight for the investment survival. This is a battle for the investment survival, and up and down, but it's really tight. And what that tells me is we're at a tipping point where this thing's going to move one way or the other. Rarely do markets go sideways for very long, and so I'm optimistic about that, because the last several months, year and a half, we haven't had a lot of sideways movement. And so I'm looking to see leaders emerge. I know there are some kind of older school businesses like home builders have done pretty well here recently, but there's a lot of new buzzwords in artificial intelligence, and we're seeing that played out in the news media. I think the White House even crowned a new artificial intelligence czar, if I'm not mistaken, which I just had to laugh at. But nevertheless, it's in vogue, and it's what's happening. It's what's new, and that's what wins. The new stuff wins and leads out. We're looking for innovation. We're looking for doing things smarter, quicker, more accurately, and AI has a lot to bring in that department. And so it could be the thing that takes the NASDAQ to a new level.
I don't know if I told you that I was talking to a tech friend a couple weeks ago, and he was talking to me about artificial intelligence and the Bill Gates strategy. Did I tell you that?
Well, I don't think so.
Yeah. And what he said was Bill Gates never really cared to get Microsoft Windows.
Yes, you did tell me. Yes. Okay.
I don't know if we told our friends.
We didn't tell our friends. So.
Yeah. So what his strategy wasn't to sell you and I a copy of Microsoft Windows. His strategy was to create enough anxiety in the politicians and the government people's minds about the possibilities with that it got them so anxious that they would appoint AI czar. Consequently, they would then start buying the software in millions and millions of copies so they can monitor what's going on themselves to watch out for us.
You're like a prophet.
so here we go. We have an AI czar. I did see on that this week, Doug, that last quarter AI was mentioned in the top tech companies quarterly calls 16 times. So far this time it's been mentioned 106 times. So it's a buzzword that you have to have in your quarterly call to be relevant, it seems like.
Well, and it's gaining traction. I was at a conference last weekend in Nashville, Tennessee, and this was a group of just people wanting to pour into personal development. This could be growth on a personal level. This could be growth business, spiritual, relationships, personal finances, all of that stuff. And we had a great breakout session on artificial intelligence. And one of the questions was, how many of you go to ChatGPT once a week? And it was almost every hand went up. And so it's nothing new now. It's out there. But I love to see it trending in the marketplace. And now we just need a leader. I mean, it's kind of like the early days of the automobile. There are a lot of different companies out there, parts manufacturers making bodies for cars, all this stuff. That I think we're going to get to the place, and it could be through regulation, where the dominant player punches above their weight.
Well, what my tech friend, and I'm speaking like a foreign language when I mention this to you, what my tech friend told me, he says that what's funny is ChatGPT isn't even artificial intelligence, which is like talking about, how exciting automobiles are. just by going and looking at a motor as a part of it. It's not getting you down the street. And
Yeah.
really what he informed me to is all that Chat GPT represents is a really fast database is what it is. And so he said what artificial intelligence does is something even more than you're going to see on Chat GPT, but Chat GPT will just show you what, like how crazy things are going to be probably. And it's pretty crazy.
Yeah, it's pretty crazy. But anyway, so when we look at the NASDAQ and we looked at that tight weekly pattern, it's at a tipping point. Or an inflection point maybe is what we're looking for. We're looking for a change. And could we switch to the S&P 600?
Well, let me talk on this real quick before I go to the next thing. Our friend Mark Minervini talks about a volatility contraction pattern. He calls it a VCP. And essentially when markets or stocks or commodities even are beginning to take a move one way or another, they tend to have very volatile shapes like these little V's I've drawn here. And then they get tighter and tighter. You can see the range of these it's getting smaller and smaller as we go to the right. And so this range right here, how tight this is, if we're going into a bull market, this should come out of here and it should do it with some real high volume over there. That's what it should do. If it doesn't do that, if it reverses down this way, it gives us another indication it's just not time yet. And time in the market is not necessarily the answer. That's what a lot of mutual fund companies will say. It's not timing the market, it's time in the market. Well, if you were in the market all of this time right here, you would have been one of the statistics I saw this week. And it said the average, according to T. Rowe Price, the average 401k balance in 2022 dropped 18.9%. Did you know that?
Yeah, I was seeing something similar. It's on a 60-40 portfolio and it dropped 20% in 2022.
Yeah, so that would probably have been what this was.
Yeah.
And this is T. Rowe Price. Data is data.
In 60-40 being 60% equities, 40% bonds.
Right. And what I wanted to point out is that whether it's 20 or 18.9, those 401k plans have contributions as well. So it not only absorbed the capital that was there, they lost more than that amount because they lost their contributions that year. So time in the market is not always more important than timing the market. Just that's our religious beliefs on these things. So I won't
like a little bit of both.
Yeah, we'd like to be in it longer term, but it isn't cooperating right now. Here's the S&P, Doug. Oh, you said what'd you say, the 600?
600. We'll do the 600 and then we can even look.
That doesn't even look like what we just looked. That looks like we're on a different planet, doesn't it? These are the smaller companies, in case you didn't read the label at the top, folks.
This is just a great reminder, friends, that there's a lot of stuff going on in the market. And I know we hear the Dow Jones in media. I know we hear the S&P 500, but this tells a lot of the story. Is the smaller companies, the more agile companies are struggling. And they haven't even ramped up to their 200-day yet. This looks like the type of stuff we were looking at, like, I don't know, back in
almost a year ago.
October.
I think it was even a year ago where it looked like that. The NASDAQ did.
Yeah, and just brutal. And so now I will say this, guys. I think one sign of encouragement here is it hasn't hit the lows of October. It looks closer to that than not, but nevertheless, that is an encouragement to me. And when I analyze this and the other charts that we looked at, the S&P 500, the NASDAQ, we haven't retested the lows, and that's a positive thing. Let's take a look at the 400 real quick, Keith.
Hold on before I jump. I think we have some folks that are accustomed to looking through microscopes at some point in their life. And if you were to take this S&P 600 and put it under the microscope, this little rectangle I drew here, most of this is accounted for. What happened right here is accounted for because most of this, the local banks are going to be in this index. Consequently, they have just been brutalized as a result, not of their own doing, and I'm going to give credit to where it's due. It's credit to the Federal Reserve and the U.S. Treasury's poor decision-making caused these banks who are doing their own thing, managing business the best they could, caused them a lot of their capital and maybe their livelihood. I don't know, but that's my soapbox. I'm getting off.
Well, and it's probably around that time that the earnings of the big financial banks were coming out and being celebrated. But so this is the mid cap, and so this is a step up from the small caps. But again, you can see the same type, same type of pattern where there's a real fight for that 200-day moving average.
So the essence is this market, and I'll show you this screen as well, fans, friends, people out there.
Fans,
I like it. They're raving fans. One of y'all came up at Debbie's retirement party and gave us such a compliment. I got a big head and I got home for dinner and got that adjusted. So that is it is just an honor to be here hanging out with y'all. And this is the screen that shows me the breadth of the market. In other words, is the market really going up, or are just a few of the stocks driving the indices up, which gives you the false sense that this is a healthy market? And I've kind of explained to you, I've started following this almost 2 years ago now. And what I do is our database, I update the number of stocks in the database. Over here to the left, this week there's 14 more, 96, 64. And then I put the number of stocks that are below the appropriate moving average. The 21-day, that just tells you what's been going on this month. The 50-day, roughly the last couple months or so, and then the 200-day, roughly the last year. And you can see that whenever one of these gets more than 50% of the total, I highlight it in yellow. And generally speaking, when those things go yellow, the market has not done well for a spell. And so most of last year, if I scroll down here, there was yellow out there, and it just showed you that it's probably not the safest time to be swimming in that particular pool. So
this is the Keith Tyner index, by the way. We haven't filed for a trademark yet, but it's pretty good.
It's a little invention I came up with one night.
This is the clinical piece, and we have been so fortunate from other people to speak into our lives that you can operate this way. And so, but yeah, Keith came up with that, and we've put that to charts, and it's pretty impressive.
It can tell you when to put your foot on the gas and maybe when to put it a little bit on the brakes. You can buy and hold a portion of your portfolio forever if you want, but the amount of that per position really is what's involved in risk management. What do we need to look at next, Doug?
Well, I was going to go back in time, and without getting into the weeds, it's been a tough 5 years. I mean, if you go back to the floor of the pandemic, it looks good. But if you go back 5 years, it's just been a tough 5 years to make money. We've had some ups, we've had downs. But I just want to encourage you guys to take courage that America is still the best place to be operating a business. But I don't see that changing. I mean, there are so many really just amazing people out there doing creative and courageous things. And we look at the stock charts, we hear the stories, we listen to podcasts of guys doing different things and gals creating, but it's still a great place to do business. And so that gives me hope. I don't worry about my kids and my grandkids. I know there's a lot of stuff going on, a lot of noise out there, but it gives me hope because creativity is still happening.
Well, and if you think about capitalism at the core level, and I'm not talking about corporate greed where people are in the CEO office and they're making millions and millions of dollars, and they don't care about their employees. But at the core level, as a business like Gimbal Financial or all the ones up and down this street here, they are adding value to their customers' lives. They generally literally love their customers, not because of what they're getting from their customers, but they're able to express their giftedness and who they are and do it for a profit. And that's capitalism, is to offer something to somebody else that they think is of value. You're able to give it to them and make a profit and feed your family.
And another step of that is so encouraging, and we get to see this all the time. I'm seeing it right now. You've probably gotten some phone calls on this week. Folks have met with their accountants, and now they're starting to think through what the rest of 2023 is going to look like. And just this week, I've had people calling in, hey, Doug, we want to give charitably through our retirement account. How do we do that? Can we get that done? And what a benefit of capitalism. I mean, these people don't have to do that. but out of love for what they're a part of and their vision, that they are doing that right now. And that's wonderful.
It is and me being the devil's advocate is one of the beauties of the charities in the risk taking of the capitalist is the government, as I see it, as a charity. They're not doing really anything, but any profit I make, they profit off of.
Oh, yeah.
Yeah, and so they should say
Take a look at your property tax.
right, whatever. Yeah, and that's what I've been hearing this week is people in central Indiana have got their assessments and they can see. And I think maybe that's going to help push back government if all the homeowners reach out to their local politicians and say, I realize my property went up, but your spending does not need to go up alongside, because probably if we go into a recession, my property value is going to drop. And if you knuckleheads spend more, we're going to be in a deeper problem. So reach out to your local politicians and maybe you can even go beyond that. But that's all I have to say about that, Doug. I've got what I think is a lot of fun is last year, Rich Strike won the Kentucky Derby at an 80-1 odds.
Yeah, that's right.
And I forget my probability, but I think that means there's an 80% chance that it's not going to win, right? Like 80-1 says it's a long shot that so one way you could say that is if the long shot won, it's probably going to be another 80 years until a long shot wins, right? And the biggest long shot to win was 1913, and it was a horse by the name of Donerail. Did you know this?
No, I don't know it.
91-1 were the odds.
Okay.
And Donerail was ridden by a guy named Roscoe Goose, and Roscoe Goose was called the Golden Goose. And he made an agreement. I don't know if he would have made the agreement if he wasn't a long shot. He made the agreement before the race with the other jockeys. No, I think they all did it. So it wasn't just him. That if we win the race, we're taking our share of the purse. We're going to the Silbach Hotel. If you've never been to Louisville, it's a really cool hotel. And we're going to party with 100% of our winnings. And so you may have gone to a Kentucky Derby party before, but I'm guessing that was the Kentucky Derby party of all time. And Ross,
back to the people.
Give him back to the people. And Roscoe rode in the Kentucky Derby when the idea of don't cross the fence was a whole different idea.
I don't even know what you're talking about.
Well, our warning at the beginning was be careful crossing fences, right? I was talking about the Kentucky Derby because those horses are flat out flying.
Gotcha. Okay,
and if you cross the path of a Kentucky Derby horse without any other protection, it doesn't end well. And I saw an example of this because I was trying to find out more about Donerail. And so I put on YouTube 1913 Kentucky Derby. I wanted to see the race so I could do it. And the first thing that popped up was the Derby of 2013.
Pretty cool.
Yeah. But in 1913, in 1913, the Derby was not the Kentucky Derby. It was a Derby over in Europe. And in that race, there was a young lady, see if I got her name in my notes. I didn't put her name here. You'll have to go back and watch it yourself. She was a feminist activist, well known in the time, but in the Derby that was going on there, the horses came around for the final stretch. She decided, because there weren't fences there, she decided to go out on the track.
Look twice.
And there was another horse coming and it didn't end well. But the reality of it is there are risks in everything. Whether we put the fences up, whether we protect you, each of us have to look every way in everything we're doing and take personal responsibility. I'm sorry that happened in 1913. More fences are not going to help us in most things in life. Taking personal responsibility is going to be the thing that makes the most out of you enjoying life, I think. Do you have a pick for the race?
No, just enjoy your own race. I don't even know who's running, but I do love to watch it.
Yeah.
But yeah, enjoy your own race.
Well,
you're my pick for the race.
I know who our co-worker, his dad's name's Phil, and his name's Phil, and his pick, I forgot, is it Two Phils? Is that who? Two Phils is his pick for the race. I would, that is not a recommendation.
Two Phils makes the dollar bills.
There you go. You guys have a great weekend. We'll see you soon.